Infosys has just delivered its Q4 numbers and it's a shocker on the way down. Constant currency revenue growth has fallen. It's fallen by 3.2% versus expectations of a bit of a growth. The deteriorating macro is hurting Indian IT companies' top line. Projects appear to be put on hold and margins too for Infosys have fallen on a sequential basis. Remember, even in the COVID hit quarter, the performance was not as bad. At that time, the decline in revenue was restricted to minus 2%. But this time, it's a minus 3.2%. The focus is always on the FY24 guidance because it's an uncertain macro, and what Infy has to say will set the tone for the rest of the IT companies and will also set the kind of valuation multiples IT companies will enjoy. Infy has given a fairly cautious guidance. 4 to 7% revenue growth, which compares with 15.4% growth clocked in the prior year, and margins at 20 to 22% versus 21 to 22% growth that they've seen in FY23. They finally ended FY23 with margins of 21%. So this has really been a reality check of sorts for Indian IT companies. Yes, TCS also missed both revenues and margins, as so has Infy, but the margin of miss in the case of Infosys is far more, particularly on the top line. What the management commentary has to say about the outlook, the demand environment, and what's making them so cautious and uncertain will set the tone for the rest of the Indian IT companies, because there are only two of them in the large cap space which give you an annual guidance. One of them is Infosys and the other one is HCL Tech. And Infosys, being the bigger one, is seen as a bellwether. You have Salil Parekh, the CEO and MD. Okay, he started speaking. Let's cut across in here.
An excellent full year performance in financial year 2023 with a growth of 15.4% in constant currency. Our digital business grew at 25.6%, now being 62.9% of our overall revenue. And our core services grew as well at 1.9%. We had 95 large deals with a value of $9.8 billion for the year, 40% of which were net new. Our operating margin for the full year was at 21%, and our attrition has continued to decline in each quarter of the year, including in Q4. We are leveraging generative AI capabilities for our clients and within the company today. We have active programs and projects with clients working with generative AI platforms to address specific areas, processes, and libraries within their business. We have trained open source generative AI platforms on our own internal software development libraries. We anticipate generative AI to provide more opportunities for work with our clients and to enable us to improve our own productivity. In Q4, we saw changes in the market environment. During the quarter, we saw unplanned project ramp downs in some of our clients and delays in decision making, which resulted in lower volumes. In addition, we had some one-time revenue impact. While we saw some signs of stabilization in March, the environment remains uncertain. This led to our Q4 year-on-year growth of 8.8% in constant currency and quarter-on-quarter decline of 3.2%. Our operating margin was resilient at 21% for the quarter. We had $2.1 billion in large deals in the quarter. Our pipeline of large deals is extremely strong. Several of these are mega deals, and several of them are opportunities for cost and efficiency programs within clients and consolidation opportunities. Based on our sustained momentum in the financial year 23, the strong pipeline of opportunities, especially the ones in cost, efficiency, and consolidation, while also keeping in mind the uncertain environment, our revenue growth guidance for this financial year is 4% to 7% in constant currency. Our operating margin guidance for the financial year is 20% to 22%. Thank you, and over to you, Rishi, for our questions.
Thank you, Salil. We will now open the floor for questions. Joining Salil is Mr. Nilanjan Roy, Chief Financial Officer, Infosys. With that, our first question is from Ritu Singh from CNBC-TV18.
Hi, Salil. Hi, Nilanjan. Your constant currency revenue decline for the quarter is, far worse than what the street was expecting. And that sort of explains why your full year revenue growth guidance is missed, what you had guided at 16.5%. I just wanted to understand, where are you seeing softness? I remember reading your comments that your exposure to US banks isn't that large. What are the verticals that are seeing softness? And also on your margin guidance, which now for FY24, you've brought to about 20 to 22%. Again, last year we thought was an aberration because of higher wage bills, and the expectation was that it would be brought back to 21 to 23%, which is not the case. Could you tell us a bit more about why this? And a second question on attrition as well, which has been coming down. If you expect that trend to continue, and your hiring plans for the year, please. Thank you.
Let me start off with the market. Nilanjan will share a little bit about the margin and the other points we'll come back to as well. On what we saw in Q4, during the quarter, we saw some ram downs which were unplanned, and these were across different sectors. We saw some in telco, we saw some in high tech, some in retail, and within financial services, it was on mortgages that we've talked about in the past, in asset management and investment banking. So those were the areas in which we saw things which were unplanned. In addition to that, we saw some one-time impact in the quarter. Now, in terms of the margin, go ahead, please.
So I'll take that. So we've ended the year, as you know, at 21, and this has been pretty stable as the year has gone by. So 21 was the full year margin as the exit margin as well. And in a way, it's a midpoint between 20 and 22. It gives us the flexibility in this year as well. So we will have some headwinds, which we'll see with compensation. We will have some travel coming back. But we know with things like utilization, more automation, etc., we also have a runway to increase the margins. But this gives us the necessary flexibility into next year.
Is it, how it usually is with Infosys, like even with your revenue guidance last year, you started with something and you kept increasing it every quarter. Should we expect some sort of upside risk to these guidance figures you've given us for this year as well, for FY24?
So the guidance we've given is based on what we see from the deals we won, this 9.8 billion in the year, plus what we see with our steady business and the outlook we have in the demand environment today. So that is the way we build our guidance. That is the way we look at it. We don't have a view on what will change as the year progresses. On hiring.
Sorry, what was the question again?
Hiring and attrition.
Earlier was on attrition and hiring.
Attrition and hiring.
For next year?
Yes, for FY24.
Yeah, FY24. So looking at the volumes, one is we have a lot of bench with us. In fact, over a long period of time, we have kept this bench. They are ready to move into production projects. But of course, they will take time as volumes come in their own pace. And of course, we have an agile model of hiring off campus as well. So as demand picks up, we have that flexibility as well. So I think our model in terms of hiring has got enough flexibility to take care of new volumes. In any case, we have a rich bench. 80% utilization is what we have, and usually we've operated well above that.
Thank you. The next question is from Shilpa Phadnis from the Times of India.
I just wanted to understand from you, if you look at the guidance for the next year, it looks really understated, and way back in 2016 is when you had the low single-digit guidance that was re-revised downwards. I just wanted to understand from you, where are the headwinds coming from? Is it largely in BFSI? Last quarter also you called out some sort of account headwinds. Can you please take us through that? Second, you said one-time impact. So is it largely related to ramp down or any other client-related issues? Can you please help us with that?
On the first, I'll address it. Nilanjan will come back on the second one. We saw during the quarter certain clients where we saw these ramp downs which were not planned, and they were across the telco sector, retail, high tech, and financial services, parts of which mainly focused on mortgages, asset management, and investment banking. So it was across those industries that we saw some of the constraints that came up.
Yes, on the revenue one-timers, so most of the decline in revenue actually was from volume. And the impact of revenue one-timers is a combination of cancellations, actually, exactly what you said. So the combination of cancellations and also some specific, client issues. So it's a combination of that, but most of the decline actually has been from volume.
Okay. I had one last question. With the two presidents leaving the organization, do you see some sort of a restructuring that you're going to announce? You're going to break up some of the verticals into, which are anyway monolithic, and you're going to break it down into smaller business units. Is that plan underway? And you ventured into the delayering exercise, delayering of the top. Delayering, yeah. So I just wanted to understand from you, you've not called out replacements for the two presidents. Is Infosys breaking away from the past in terms of doing away with the president structure?
So we've announced and rolled out internally a structure which is focused on delivery with the exit when Ravi left. We're in position to now roll out the structure that will be for financial services as we move ahead. What we see is within Infosys, we have a strong leadership team. And so we are fortunate that the leaders are coming from inside, and that we see more and more at the next level. There is no delayering plan within Infosys at all. Our organization structure really is something we are building which is agile and also quite solid to deliver our consistent trajectory that we've been driving through. We have, as you know, growth drivers on digital and growth drivers on cost and automation. And so those are the ones that we'll continue to drive. And we have probably the best delivery organization in the industry. So we want to continue to enhance that with the team we have.
Thanks, so the current responsibilities will be split between other leaders in the organization.
Sorry?
The current responsibilities of BFSI?
Other leaders, the leaders within the company will step up. Okay. And also in delivery, it's done. So everyone is done. The next one will be done in the next few weeks.
Thank you. The next question is from Joshelle Mendonça from ET Prime.
Hello. I want a clarification on something you've said in the press release. You've said you've expanded your internal program on efficiency and cost to build a higher path to margins. I'm asking this specifically because I'm looking at headcount, and headcount fell in the quarter, but it fell more on the software professionals while sales and support staff actually went up marginally. So could you give me some clarity on what this efficiency program is and how it's feeding into how you look at the sales staff, and what augments or detractions you might make on that front?
So that I think is a very critical program. We were running it. In fact, Nilanjan was driving that with a very strong team. We have expanded the attention to that program during the last quarter. We have several methods in which we can do better in that program, whether that relates to automation, it relates to pyramid, it relates to on-site mix, relates to subcontractors, relates to travel, and also relating to pricing and how we can drive that within our system, given the inflation that all of us have seen. What we are communicating with that is that program gets very focused attention, and we have within our internal way of looking at it, a path to bring us to the aspired margin that we want, because we want to be at that margin as we go ahead. Having said that, we have low utilization that Nilanjan mentioned. We are going to make sure that we look after our people with that commitment. We're going to make sure that we continue with the training, and that's an area we will continue our focus on. We are not going to take some short-term actions against that. And that team that will start to work on projects as well.
Thank you. The next question is from Chandra Shrikant from Money Control.
No, going by the guidance that you mentioned, can you give us a sense of the incremental revenues that you will be adding for FY24? Because Based on a back of the envelope calculation, I think it will come up to some 300 million to 500 million compared to the 3 billion that you added in the previous fiscal. So can you give us a sense of how much incremental revenues you expect to add in FY24? And Salil, what are you hearing from clients? I mean, yesterday the TCS management mentioned that, discretionary projects are getting deferred. There are no cancellations or, budget cuts, but that clients are spending wisely. If you can give us a sense of, what the conversations are like, what kind of, deal discussions are happening, and how impacted are you by the regional banking crisis in the US? I think JP Morgan recently said that, you and TCS have the highest exposure to regional banks in the US. So if you can give us a sense of that, because financial services has declined quarter on quarter and year on year. So
the first part, on the regional banks, Nilanjan will come back with that. But on the first part, two parts to what you asked. One, on the incremental revenue. So as you know, we don't give a specific dollar number for that, but our guidance very clearly allows you to interpret it. 4% to 7% constant currency growth on the base, which now is closed in March 31. So both reported and constant currency, we have those numbers. But that is our guidance, which will therefore give you the incremental revenue. Now, what our clients are telling us now, several clients where we've mentioned, several industries where we've talked about telecom, retail, high tech, and parts of financial services. There are some clients which are seeing in their own business whatever constraints they're seeing with the economic environment. As a consequence, we have noticed that some decisions were made during the quarter to stop some parts of the programs, not everything, but some parts of the program. And that's what we observed in the quarter. Plus, what Nilanjan and I also shared, some one-time impact in the quarter. Now, what we see going ahead, we saw some stabilization in March, but the demand environment is still uncertain. We saw in the last quarter with certain banking situations changing both in the US and European geographies, those things impacting decision-making across the board. With that in mind, we are working very closely with our clients and supporting them, making sure that we remain committed to our clients as they go through their way of dealing with the situation that's changing. And we believe that as we did in the past, the clients connect with us will help us massively in the future as well. Having said that, we have an extremely large pipeline, the largest pipeline we've seen in a long while. While there is still slowing in the cycle of closing the deals are very strong, and some of them mega deals. So we feel good that there is a pipeline in there focused on cost and efficiency and consolidation.
I think the street was expecting 21 to 23%, and I think you've given 20 to 22%. So again, what are the pressure points there? Is it rising on-site costs?
Yeah, so like I said, we've ended the year at 21, and in fact, the quarter was closed at 21, and the full year was 21. So we've seen a very steady 21%. And frankly, that is the midpoint of between 20 to 22, and it gives us the flexibility to look at certain headwinds if they arise. There will be some increases, like I just mentioned earlier. It'll be in terms of travel, compensation, and of course, we have the whole benefit of utilization, the pyramid, etc., to work. So I think that's a fair range, and of course, aspiration continues to be to improve our margin profile.
Thank you. The next question is from Sai from the Economic Times.
Hi, gentlemen. So looking at the guidance, I just wanted to ask, even last year you had given and you had kept updating it, right? So would you call this some sort of a misstep or like kind of, seeing the demand forecast as, overestimating demand? And also I wanted to know, you were saying that a lot of project cancellations and, one-time impact was there. So has that impact subsided, or do we also should expect similar pressure in the pipeline that's coming? Yeah, and also for Nilanjan, I wanted to know the campus hiring target for FY24. Thanks.
So there, on what we saw, many of the things that Nilanjan and I shared earlier today were things that happened in the quarter. For example, some of the clients that decided to slow down or stop some of the projects. So these were things we had not seen at the start or at the end of last quarter. And that's what we felt. We've also seen some of that stabilizing in March, but the demand environment is uncertain. So we are making sure that we keep that in mind as we look ahead and remain agile as we look ahead.
So on the freshers, like I said, we have a very rich bench now. We've hired more than 50,000. We had said we will hire 50,000. We actually hired, I think, 51,000 last year. And a lot of them on the bench are getting skilled, are getting trained. So we have quite a leeway for the next few quarters in terms of the availability of freshers. And of course, with our agile model of doing both college and off-campus recruitment, we can always turn that up. So we have no specific number for FY24 at this stage. We have enough actually today sitting in on the bench.
Thank you. The next question is from Haripriya Suriban from the Hindu Business Line.
Hi, guys. Salil, you mentioned about slowdown. I just wanted to understand, is it more sentimental or is it structural via these deals getting delayed? And on the ChatGPT part that you mentioned, are there any specific use cases that you guys are working at? And we keep hearing that ChatGPT could make jobs redundant or something like that. So would roles change? Would the nature of jobs change? And are you internally training employees for these technologies?
The first part was what, secular or?
Is it sentimental, the slowdown that you're seeing and the client behavior that you're seeing? Is it sentimental because everybody's scared, or is it structural?
Sentimental. So there, what we're seeing is, some clients have made a decision to slow down or ramp down projects. We see that across the different industries that I mentioned, telecom, high tech, retail, and parts of financial services. So I don't know whether it's sentimental or structural, but we've seen that as the way the clients have interacted with us. As we were sharing, we saw some stabilization in March, but the environment is uncertain, so we will see how it plays out. On generative AI, we are working with multiple platforms. We are working with open source platforms, and we are working with proprietary platforms. We have active client projects today. The projects that we are working on are focused on large models within the client organization for different areas, and how generative AI can take advantage of those large models and create something that is more efficient for the client. And then we are working on our own software development tool on an open source generative AI platform. We're actually working with two of them, and we are training it on our software development libraries. We've already done that with several of our internal software library elements, and we feel quite good that these things are going to help us with client work, so more work, and also with productivity. So it's really incredible how we think our organization has moved quickly into driving generative AI within our business. And it's now part of all the new training as well, because once you have it for your own software library, you can really deploy it very effectively.
Thank you. The next question is from PP Thimaya from Your Story.
Hi. Just two questions. One is the kind of, the negative growth you saw in this Q4. Was it kind of, I understand the SVB crisis and the banking crisis and the Credit Suisse and UBS crisis, but was it expected? Such kind of deep cuts for Infosys as such from a revenue perspective. And secondly, the kind of revenue outlook you're given for the current financial year. Is this a long-term trend you're going to see, that the overall growth rates is going to be in maybe high single digits or below 10% kind of thing?
So there, first, every quarter we look at where our, let's say, wins in large deals, overall wins, plus the current work is, and we build what our estimate is and what our forecast is for the period ahead, for the year, for the financial year. And that's the guidance or update or change that we've given. And we've given that consistently over the last several years. We saw a different kind of when we were at the end of last quarter, and then things changed during the quarter, which is what we shared with the projects ramping down. Now, looking ahead, first, if you look at, let's just say the last couple of years, we had 19% growth the year before, 15% this past year. So we know that it depends on where the economic environment is and how we see that. We think our business has two growth drivers. When there's a huge change going on within our client organizations and they are putting in large investments there, there's digital transformation, and we have deep capability in that. That comprises of cloud. We have very strong capability on COBOL. And then when there are different areas where the client wants to focus on efficiency, costs, even consolidation, we have a very strong capability in automation, our own AI that we've used for that in the past. So we feel comfortable in both of those dimensions, depending on how the economic environment is.
Okay, that is the management from Infosys, not allaying too many concerns. I think the principal reason is the unplanned project ramp downs. And the problem is it's not just restricted to one BFSI vertical, which we know from the headlines that it was under pressure. Even other verticals like retail, high-tech, communication, telco, all these segments have seen unplanned project ramp downs in the quarter, which has impacted their performance. Not just that, the company also said that there was this one-time impact on revenue due to a combination of cancellation and some client-specific issues, which means that unlike what TCS said projects were deferred. They were put on hold. They were paused, but there were no project cancellations. But in the case of Infosys, it's possible, based on that management commentary, that there were a few cancellations as well, which he called out as a one-time impact. So those were the principal reasons for the miss this time, the deteriorating macros really hurting Infi and particularly, TCS and particularly Infosys this time. Infosys growth has never been so bad, at least in the last 10 years that I've been tracking the technology space. We're going to wrap up our coverage on Infosys. We'll keep getting you more and more headlines and other news, so stay with us.